Have you ever wondered why so much persons fail at investing? It's not because they're bad at picking stocks or they're bad at maths. It's because of this one powerful force called psychology. So fear, greed, impatience, and hype can all destroy someone's portfolio faster than any market crash. And today in this video, we'll be taking a look at the psychology of an investor and why we continuously fail. And basically how to combat said issues. So with that said, of course, don't forget to like, share, comment, subscribe, to a friend. With that said, let's begin. The first failure begins even before we actually even start investing, and that is fear. Fear of losing money, fear of making mistakes, fear of looking foolish. In my early years, I was ignorant in a lot of stuff. So I essentially went to the same phase as you. I was even at a point where I asked CFA holders to explain certain basic concepts that I never knew at that time. For example, I'm going to make you guys listen to recording of when this was a couple of years ago. So yeah. Anyway, so like say me I do some research for a company. Say company will more actually investing and such. What do I look for? I think
You want to invest in something?
yeah, we want to know if it's a good company or a bad company.
Because when you think about different like investment strategy, so it's time for the buy and hold.
Pretty much done. Most part.
So you want to buy and hold the capital gains
Dividend.
and dividend income.
At least how my strategy is a case where like each year start this year, each year I have like a target or like capital that I want invested. So this year was 70K. So if I was afraid of doing anything, I wouldn't start investing. So while we're afraid, inflation in the back end just chipping away at the value of our dollars. See, KFC raise them prices now, so you can't even get a two-piece for $1,000 again. So if you want any more clarity, there is it. Good investing, all you have to do is just start small and be consistent and just focus on the long games. Initially, your gains will not be a lot because you're probably depositing a small amount of money. However, as time progresses, it will get bigger. And as a beginner investor, there are 5 things that you should know. I did make a video about this about 3 years ago, but that was a different me at that time. But you can check it out. It's a relaxing watch. But I'm gonna just sum it up into 5 main parts. The first thing you're going actually need to know is how the company actually makes money. Alright. If it's too complex to figure out how the company actually makes money, then as a beginner I wouldn't necessarily recommend you trying to venture into that company. If you're unable to explain how the company makes money in less than one sentence, then as a beginner I'd say leave it alone. Alright. Second thing is, what is the company's economic moat? What is the advantages it has over its competitor? For example, JPS. Their advantage is that they're the only distributor of electricity to Jamaica. Yes, there are other producers like Wigton, etc. But at the end of the day, Wigton has to sell the energy to JPS in order to actually get their current to us. And that is why JPS fight tooth and nail to not get a second competitor, essentially. Yeah. And in addition to that, economic moat is also that there's a very high expense cost for a competitor to come and build out all of the new grids and everything that JPS already had been doing over the decades. So there is that. The third thing is, will the company actually go bankrupt? And as a beginner, best thing I'll say, just go on the income statement of a company's financial and look at their net profit. Is it that each year they're making more and more money? If yes, then you are probably okay, right? Granted, there are other complex calculations such as Almond Z-score 5 and 6 step that stress test the company's financial statements in order to see whether or not they can withstand, let's say, a bad year or two without going bankrupt. However, as a beginner, I don't necessarily think you need to that. You just look at the financials and you should be fine. Right? As long as they're making more money year by year, you're supposed to be good. The fourth thing is, will the company be relevant in the next 5 to 10 years? For example, Jamaica Broilers. Jamaica Broilers sells chicken to everybody, both living and dead chicken themselves. Ah, yeah. So yeah, they sell the living chicken to like farmers that raise chicken, but they also sell the feed and the wormwood and whatever else them put in the chicken to the same person they're selling the chicken to. So they are going to be relevant in the sense that they sustain a lot of person's livelihood in addition to the fact they owe them sell chicken. Although they do other poultry and such, but chicken is their main thing. And if you don't think you're going to stop eating chicken in the next 5 years or so, I doubt other person's going to stop eating chicken as well. So the fifth thing is to understand this: who is the CEO. Predominantly, I would prefer a company that has a CEO for a very long time, because that shows that yes, the company is in good hands. If the company is constantly changing CEO, then it might mean that there is some issue at the top and it can trickle down to the bottom line. Right? For example, Don Webby, he's been at Grace for forever, so there is that. Plus, then you also want to know that the CEO that is running the company has been performing, as in meaning each year they have been making more and more money. But not only CEOs, you also have to watch out for the directors, because they can fire the CEOs. So there's that. So what you can do is, as long as you look at the financials, they'll go and show pictures of the CEOs and directors, so you can, you know, yeah, work with that. So as long as it's the same face the last probably 4, 5, 6 financial statements, you're good. And I guess a bonus one I would say is six, which is branding. I'll go and say a list of companies and you tell me how you feel about them. You can say in the comments. However, just when I say it, how do you feel about these companies? So the first one, NCB, Transjamaica, JMB, Grace Kennedy, One on One Education Limited, Dollar Financials. Any way or any type of way you feel about the company when I said it, that's your perception of the brand. And that is branding at play. So whether it's good or bad, that is branding. And you want a company that has a good branding, especially in the financial industry. The financial industry biggest currency is their reputation. So yeah. Now that we have gotten over fear investing, another hurdle is panic selling. Now, for example, let's say you buy a stock at $10 and it dropped to $9. And because you're new to the whole investing thing, you're upon sell out to say, hey, I'm going to be saving the rest of our money because I don't want to lose anything more. And then the following week it goes back up 10, even $11. And you feel some type of way about that. And I'm pretty sure that it sounds familiar to at least one person watching this video. But here's the thing. With the stock market, you have several persons buying and selling while trading session is open. So it is normal for the prices to actually fluctuate. More seasoned investors use these as entry points to even buy more offset stock. As long as there's nothing fundamentally changing with the company, the day-to-day fluctuations of the stock market shouldn't make it affect you. Honestly, just buy it. As long as everything is cool with the company and there's nothing wrong with the company per se, the stock price is going to fluctuate. So, yeah, not for about that. Honestly, the key is just stay calm and just focus on the long term. After you're not going have all the money one time to buy the amount of stocks that you want, you're just going to buy it incrementally and just continue. The third fear is FOMO, or even just jumping on the hype. All right, so with FOMO, fear of missing out, meaning that you are afraid that if you don't participate in a particular, let's say, IPO that comes out, you're going to miss out on all the potential gains and then something there. All right, or even just jumping on the hype with everybody. So over the years, you may have seen your friends making crazy money with buying IPOs and flipping and selling. The first thing first, IPO thing in Jamaica has died down. I must say it has died down because honestly, some of these companies are coming to the market not offering much. So the smart persons will still buying a little bit, but it not you're not going to see those 2, 3, 4x jumps like they used to, especially because there are more investors in the market that are a bit more smarter these days. So everybody not just blindly throwing their money at companies again just because they have IPO on it. And I even see companies brandishing the word IPO, kind of devaluing it in a sense, even when it's not actually an IPO. But just because when people hear the word IPO, then jump towards it, they just use it. You know what I mean? So I say, if it's a company you really like and you have done your due diligence, yes, you can buy into the IPO. But sometimes it may not be best to jump in. Just ensure that it aligns with your investment plans. So if you say, all right, I'm investing in gas companies and food companies alone, when some investment company comes along, don't jump onto it. Just stick to your goals that align with your portfolio and just work from there. So just remember, patience is key. And speaking of patience, the fourth one on the list is actually overconfidence and impatience. Like I say about IPO, let's tell you a story. So I had a friend, very, very close to me, matter of fact, my best friend. And the market has not been like, giving out an IPOs or anything. So he's just been having some money sitting on, and it was a recent IPO that came out, and I'm going to reach IPO, but it happened in this year. And basically, he put a lot of money in the company because his previous IPO investments went well. So him normal doubling money at probably 1.5 it. So this time now when he put a lot of money in it, matter of fact, yeah. So this time now when he put a lot of money in it, the IPO never go as planned. Matter of fact, it opened below IPO price, which end up losing after dead year now. I wait and I worry if its stock price will go up on them some there. So yeah, remember in the market, not every company is the same, and not everybody will get this. Not every company will get the same support as another, right? So don't be too overconfident because the market has a way of humbling us. Trust me, the market has a way of humbling us. So just yeah, invest especially in risky stocks or whatever investment they're doing with money that you can afford to say, well, if it goes to zero, I'll be fine with it. All right. Granted, that might not be the case, especially in the local market. However, especially if it's not something that align with the goal and you just want to double your foot into something else, don't go all out. Yes, you might hit it big, and the stock price might blow up and thing you might feel some type of way, but that's hindsight. Means you don't know what happened. So you can't necessarily worry about spilt milk. You see me, you just have to say yes. Well, you get this amount, you get a good jump off this amount that you're willing to lose. Because if it was the other way around and you actually lost the money, you'd have feel some type of way and fix. So alright, so the last one I have on this list is really just a lack of plan. I can show you my Samsung notes. I have hundreds of notes of plans and things that are planned way in advance. Alright. I also have books that I write a lot in. So yeah, I do have plans. However, a lack of plan can cost big, especially when it comes to investing. Plan essentially means how much money you're going to set aside a month from your salary to do this. What you're going to buy, which of the companies you're going to buy, whatever investor you are, whether it's a dividend, stable, or growth, or a mixture of both or all. Those things help give you a clear guide because honestly, if you just randomly buy and then sell or do this and do that, you're not going to really reach far. Even the simplest plan is every month I take 10 grand and put into X stock. that is still a plan. Because you have a time and you know what you're doing. The best thing, what I would say, is also just add like a goal. Like, what is the end goal? My current goal, which when I likely to go change, is I want to have about $800,000 in dividend coming in, which about 5%, that says about $60 million invested. So yeah, it seems that I am nowhere near it, and the next video you'll understand how far I am from it. Um, but at the same time, having a plan helps. So trust me, without a plan, you're going to be lost. Because if you have a plan and something when you know say a new IPO come out, then you're going to be like, hey, this is not really a part of plan. I only invest in food companies or in energy companies, and this is not really a part of plan. So I'm not gonna do it. Um, say so. In conclusion, that was my 2 cents on the psychology of an investor. These were some real world examples that I very vague down. Some of them affected me. Some of them affected persons I know. Some of them still affecting persons that I know. Um, but yeah. So they are fear to even start investing. You having the FOMO to not stop selling your stocks. I personally am a patron of that. Three is FOMO, fear of missing out or jumping on the hype train. Fourth is overconfidence and being impatient. And five is really just a lack of plan. Alright. So I hope these kind of help you, or if any of these affect you, you can leave down in the comment. But yeah, of course, love you guys. Thank you guys for watching and catch you in the next video. Peace.